Welcome to the next edition of Pizz-Spectives. We are here with the Investment Committee of Mont Wealth. On the 17th of December 2024, we've reflected on the year's performance so far, and so far so good. Calendar year performance for the growth portfolio is 13.5%, and for the income portfolio is 8.2%. And as we record now, the portfolios are in positive territory for the month. So we're starting and we'll potentially finish well the year. So congratulations to the IC. They've done a great job so far. But here we are, and it's all about 2025 and how are we allocating capital. Now, Shane, let's bring you into this conversation now because you have just published a 15-page document on the outlook for 2025 and some key concerns. And I might hand it over to you now to highlight some of your key points. And then we'll ask questions as we go. So thanks to Shane.
Okay. Yeah, thanks, Rob. So basically, as we finish the year, the global economy is in pretty good shape. Central banks around the world are cutting rates, apart from Australia. Inflation's heading back to target and the equity market's hitting a record high. So on the surface, things are pretty good. But as we look into next year, there's a couple of things that I think will create a bit of volatility in markets. And I think that's probably the key thing that we should be prepared for. So firstly, around geopolitics, there's obviously the result of the US election and the implication for tariffs and immigration in the US. I think that will become a lot more important as the year progresses. Now, the announcement on tariffs during an election campaign are one thing, but of course, it's what the implementation is and what the timing and the size and all of those sort of unknowns that we haven't got a handle on yet. So there'll be a bit of volatility around any announcements due to tariffs and cuts to immigration, etc. The other significant parts of the election promises were around deregulation and tax cuts, and they're obviously both positives for equities. But again, the timing and the size, we just don't know at this stage. But we should assume that something will get done in all of these areas. So I think on the first one with tariffs, that will happen pretty much from day dot. We'll start to see tariffs in Mexico and in Canada from the US government. Europe, at some point, there'll be tariffs implemented there. And obviously, you just get into a response as well from these countries. And the question is how they respond. And we just don't know at this stage. So there's potential for a lot of volatility there that could determine returns for investors this year. But as things are progressing at the moment, as I said, the US economy's led the world for the last few years. That leadership in growth may start to narrow towards the end of the year. Other central banks, particularly say Europe, have been a lot more willing to cut interest rates, and we should expect growth to pick up a little bit there and the US to slow a little bit this year. But again, a lot of it depends on what happens with tariffs and into the back half of this year. But at the moment, things are looking pretty good. The US is leading growth. Inflation, as I mentioned before, that's come under control. I don't think it's an issue, but as we got into the end of the year, the main sort of issue around fixed income pricing was whereabouts is the neutral rate. The Fed's been beating drum that's around 3.5%. And if you look at market pricing from the Fed at the moment, then the market expects the Fed funds rate to get to 3.5% by September. I think the risk is that it stops short of there and we just don't get to 3.5%. We stop somewhere near 4%. So that's certainly possible. And the bond market, I think, is priced for that at the moment. So it's range traded between sort of high threes up to around where we're now at around 440. You'd have to start to see either inflation picking up or growth start slowing significantly for that sort of high threes to mid fours range to be broken. But at the moment, I think it stays fairly range bound within those levels. But yeah, we just got to keep an eye on a few things just to see how it all goes. The outlook for the Australian economy hasn't really changed that much. We got a pretty good jobs report last week. So it's hard to see the Reserve Bank cutting rates in February, but we should expect them to cut rates before the middle of the year. The economy's growing at around about 1% at the moment, which is pretty sluggish. And right now, there's just not enough room to cut interest rates. In terms of an allocation to Australia in equities in particular, then this year, I think what we need to do is to look for regions where there's going to be a pickup in earnings growth, where earnings growth can surprise on the upside, and particularly in those markets where there is a bit of room for multiple expansion as well. And that's namely Japan and Europe, and to some extent EM, but there's a few sort of issues around EM as well that make it a bit more problematic. So I think at some point throughout this year, we can transition some global equity market leadership from US into these other markets, so Europe and Japan. Australia, there's not a lot of downside, I don't think, just given that we don't expect a recession this year. But in terms of our performance, we should be looking to those two markets that I just mentioned. Valuation is the issue for the US, so it's very hard to see much more multiple expansion at these levels. It's P's for about 21 times. So you can still get positive returns out of the US, but it'll totally depend on earnings growth. So that's why I favour markets like Europe and Japan. In terms of the bond market, so there's room for the RBA to start cutting rates this year. So I think that at some point, Aussie fixed income will outperform global, but right now with other central banks well down the path of cutting rates, and the Fed's going to have to do a little bit more than I think global can falter a bit. But again, there'll be this sort of transition, I think, in leadership between global and Aussie fixed income as the RBA starts to cut rates from the middle of the year. In terms of credit markets, high yield in the US is very expensive, and we've got a very low weight on that. But investment grade, much better valuations. US corporates are in pretty good shape, et cetera, et cetera. So it all looks much better for investment grade credit than high yield. And I'll just sort of mention the Aussie dollar a little bit as well. Where it's trading now, it's around 64, 65. Again, it's be fairly range bound, I'd imagine. We should expect more Chinese stimulus this year, particularly as the trade war heats up. China's going to have to protect its economy in some way, and that means providing some stimulus towards the consumer in particular. I don't really think they want to really set the property market off again, given the oversupply that's still being worked through there and the issues around local government debt. But I think any sort of policies targeted towards the Chinese consumer will be pretty well received, and that could provide a bit of upside to the Aussie dollar. But as I mentioned at the start, it really depends on these issues around tariffs and immigration as to what the downside is and what sort of volatility we get in markets over the next few months.
So Shane, the thing that stood out to me the most was your view that potentially the US pauses at 4%. If they cut over the next couple of days and take it to 4.35 roughly, that's only one more cut. The market's pricing in 3, potentially 4. I mean,
Yeah, that's right. So if you look at Fed pricing at the moment, it's expected to get to 4 by June, and then 3 by December, still around 380. Like you can see that pricing starting to really bottom out around about the middle of the year, and that's around that 4% mark, which so I guess not really that far out of consensus, I don't think. But the Fed still is there's further priced out a little bit further out into 2026, but I think by then it's possible we could be even looking at the next move being up rather than down. So I think 350 is probably a bit of a stretch, but you can certainly get to 4.
Yep. And then at what point, I know you've been saying that growth slows, but the US economic train continues to grow. I mean, so the service data last night was very strong. 12-month confidence is very strong. Even with higher rates, can the US economy continue to spit out 3% economic growth?
Yeah, I think so. There's no, unless we have issues around tariffs, then that can be a problem. So it depends on what happens there. And I'll get back to my point at the start, but the way things are sitting at the moment, I'd say absolutely the US is going to keep its leadership, but we know that tariffs will be implemented, and that's downside for US growth in the back half of the year. So that's kind of where the risks are for US leadership to the US to slow a little bit more than what the market's sort of expecting. So maybe down into around 2.5%, something like that, rather than 3%, which is a pretty reasonable sort of slowdown.
In the market's already pricing the first half scenario, and over the coming months, it will start to price the second half scenario for US, right? Which somehow you're saying from a Goldilocks to a little bit on the lower side of that Goldilocks. But broadly speaking, it supports our current stance of being pro-growth, pro-international, pro-US from an asset allocation perspective. Although some of the managers do shift things around, they are giving us a bit more Japan and Europe away from US. So there's a little bit of that balancing happening. Now, the question I had for you, Shane, was on mid-market, mid-risk assets, particularly real estate and infrastructure, which you have downgraded somewhat. Is it coming from the bond view, or is it coming from more the growth challenges due to US policies?
So probably a bit of both, I'd say, Jay. Yeah, as I said, I just don't think the Fed can get to 350 and that they'll stop short of that. And the market will range trade for a while up until that becomes more apparent, which is possibly around, say, the middle of the year. I think the first 4 months, I don't think there's any issue there. But with bond yield, it's possible that bond yields push out of this range and then up into something a bit closer to 5. If that happens, then that's going to be problematic for those type of assets and also growth assets as well as US growth, US equities. And that's where, if that does happen, that having an allocation to Australia actually could provide some reasonable protection, and also say Europe and Japan as well. But because at some point, the US equity market won't be able to absorb an increase in bond yields. And it's possible that could happen towards the end of the year.
And that would cap both upside in equities and also the mid-risk, right? The Mont proxies because of that.
That's right.
So that downgrade is subtle downgrade for infrastructure and property. And if committee wanted to further reduce that coming into the first quarter, then I would say some of that capital could flow through into the growth component of our alternative bucket. Rob, invest that may be a more balanced way to play the mid-risk aspect, because I consider alternative growth as mid-risk, albeit sitting in the illiquid bucket.
Yeah, that would make sense, Jay. Yep.
Interestingly, unlisted equity outperforms in volatile markets because of the illiquidity.
Yeah.
There is a place to hide there. And if you actually believe that the market's looking for that alts now and the opportunity as well to be buying cheaper assets at these prices, especially the secondaries market, then could be a good way to park some cash to make a longer term return.
Agreed on that, Rob. So if we can find a pure play, say through secondaries that gives us a 20% margin of safety plus some upside from growth, then that could be interesting. And then the other one I would say is that US mid-market corporate exposure on the credit side will also sit into mid-risk growth for us as well.
And then so obviously your views on the Australian market and economy underweight Aussie equities in a way, but does provide some protection. 2 to 3 cuts over the next 12 months is probably likely. You have a bit of a view in your note as well around Aussie property.
Yeah, with the property market in Australia over the last couple of years, the market in Melbourne's been pretty weak. Rob, invest. Sydney's been a little bit stronger, mid-single digit growth, but the large price increases have been in Adelaide, Brisbane and Perth. And those markets are just starting to slow a little bit. And work that I've done in the past tells you that once the market in Brisbane gets closer to the Sydney valuation, then it just becomes a little bit too difficult for people to relocate and move into a property that they've just bought up in Queensland. And that part of the cycle it's getting pretty close to a historical trough again. It's starting to turn a little bit, but I dare say that if we do get rate cuts, that that will flow through, and the Sydney and Melbourne markets will benefit from those. But the markets in Perth, Brisbane and Adelaide, which are more cash bias of the markets, won't get the same benefit. So growth will slow a little bit there, but there's no sort of scenario anywhere where I don't think you can get house price falls in Australia. It's just the growth in those smaller capital city markets will slow.
Question on tariffs, Shane. So, for example, with Mexico and Canada, where their currencies have depreciated quite a bit, and the US dollar has appreciated lately, is there a case where the imports, Canadian and Mexican imports, presumably will be a lot cheaper to the US consumers? So putting tariffs on that, is it a case where tariffs will be offset by the depreciation in the currency sort of thing? So maybe the impact is a little bit overplayed.
That's possible. Yeah, so the currency is an important part of that. But I think just overall that once you put a tariff on a good, then your currency depreciation, it might be 2 or 3%, but your tariff increase is 30, 40%. So at the margin, I think it helps a little bit, but not in the big scheme of things. But the question with all of these issues around tariffs and immigration is there's something's going to be said But what the action is more important than the timing of the action, I think, for markets. That's the thing that we've got to grapple with. And I just can't see any reason why Trump would just poke the US consumer in the eye after they've just voted him in to be president. I dare say reality is probably not going to be where the headline is. And at this stage, all the announcements are is just the start of a negotiation process around what he wants to achieve around immigration and narcotics coming into the US.
And in terms
It's
of
just tariffs as a weapon, essentially.
so many things are going well for the US economy, and the Fed is expected to be in a cutting cycle.
Yeah.
What would be their main reason for cutting, you think, for continuing to
The
cut?
Fed.
Yeah.
Just that policy's too restrictive at the moment, and it needs to come back to something around neutral. And it's so that's what they're doing at the moment. So that's the process right now. It's not about any sort of concerns around growth. It's just that inflation's it's going to head back to 2%. Pretty confident about that. And there's room to cut interest rates. So they're doing that. If you keep policy too restrictive to too long, then you're sacrificing growth that you don't need to. That's the argument for cutting interest rates at the moment.
Okay. Thanks.
Yeah, well, it sounds. You go, Jay.
No, I was just going to say that's the reason why the pathway for rate cut is important. And there's some risk that market is a little bit ahead in terms of the end terminal rate for Fed
that's
cash
right.
this cycle, simply because we are Goldilocks. The reason we are cutting is not because we're seeing a slowdown. It's just that the inflationary outcomes allow the Fed to reduce that from tightening to neutral and maybe a little bit easy, but not too easy.
That's right.
And albeit we're upbeat on growth, it doesn't feel like it's synchronized global growth at the moment. It is really synchronized. So it's all about allocating capital to the right money managers in the right markets. Generate performance, but also, as you said earlier, Shane, get the sense that this is going to be 2025 will be a year of two halves, where the first half will continue with strong performance from the US, but as that tapers off, as you're coming up against big numbers again, that growth and earnings expectation just tips off a little bit, and then the market will just find itself chasing itself.
Even in the US with the Magnificent Seven, you don't really need too much to go wrong for the market to be down 10 or 15%, and it's priced the way it is at the moment.
And the expected earnings growth is about 8%, Shane.
It's 11. Yeah, it's 11 now. USJ, 7 for Europe, 4 for Australia.
And
so
Japan,
a bit of upside. Europe, 11%. Yeah, it's probably okay. Australia, possibly 4. So the way things are sitting at the moment, consensus looks pretty reasonable, I would say.
Okay. So that earnings trajectory becomes key in terms of the first quarter reporting there, December reporting in February, Rob. I think that market can become jittery if there are some misses and expectations are ahead. And then the other thing is also the interaction between the earnings growth that is coming through and the 10-year bond yield. And I think as the bond yields move towards closer to 5%, you will see that puts a cap on the equity rally. And as it moves lower, it will put some support. So that's the one that to want to watch as well, is the interaction between that bond yield, 10-year US bond yield, long end, and then also what is happening to the earnings trajectory. I think it's key to our equity sort of overweight call. And so far, Goldilocks seems to be supportive that we are overweight growth and overweight via global equities.
And then the other thing to consider in Australia is the election later part of the first half of the year, which obviously always is a bit of an overhang. Confidence to invest and to do things, and we'll see how that plays out. But in effect,
it's an interesting one, Rob, just for the timing of interest rate cuts in Australia, because I think by sort of February, March, April, it'll become a lot more apparent that we need to cut interest rates. But the RBA can't cut interest rates during an election campaign. So there's a bit of a timing issue there. If they really want to get something done, but feel that the economy is going to slip too much, then they might want to go a little bit early. So they may want to go in March, April, or things slip between now and February. But otherwise, you're going to have to wait until June.
Yeah. Feels my connections are telling me that election will be in March next year. And it feels like the treasurer, by reshuffling RBA board. So RBA is trying to reshuffle the board and stuff to get a February cut. Look, I think that will be interesting, but it feels like it'll be an election call around that March sooner rather than June.
Right.
Well, this
But May's the latest date they can go.
Is latest as in election period, so maybe the announcement, but it feels, from what I've heard, is sooner rather than later is the election mindset of the Labour government at the moment.
So in summary, feels like there are so many moving parts allocating capital for portfolios. There are risks on both sides, up and down, and the way that we've positioned our portfolio is quite balanced, strategically balanced. You're comfortable how we're allocating capital, Shane?
Yeah, I think so, mate. Just got to just watch and see how things evolve over the next few months, particularly in the US with tariffs. That's going to be important, but I may have to expect volatility with all of this. We may have to meet up a little bit out of the regular monthly cycle occasionally. You just don't know.
Any excuse to see us, Shane? No doubt about it. And part of the reason.
Trip down to Melbourne.
Yeah, exactly. At that point, I might just say any information we discussed today is general information only. Anyone acting on that information does so entirely at their own risk. And if you're looking for financial advice, obviously give myself a call, but please go and seek financial advice if you're looking at allocating capital the way we like to.